Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to this episode of Through the Noise. My name is Michelle Kam, investment strategist of our bank's CIO office. The U.S. Liberation Day trade tariff announcements proved to be harsher than market expected. Under such a volatile market movement, have our views of different asset class changed? How is the macro environment likely to develop going forward? Today with me here, we have Manpreet Gill, our Chief Investment Officer of AMEE, to talk more about the topic. Hi, Manpreet. Just wondering, how big a negative are tariffs to the growth outlook?
Hi, Michelle. Thanks for having me on today. So I think you put it well at your start to say that, look, the Liberation Day trade tariff announcements did prove to be a bit harsher than what markets were expecting. And I think that's why when I look at the market reaction post facto, we saw about a 20% drawdown peak to trough in the S&P 500 before the more recent recovery, the initial fall in bonds, and of course that trend higher in gold prices. But I think to sort of focus on your question in terms of just what this means for the growth outlook, particularly in the US, I think it helps to go back to this podcast discussion a month ago, because last month we had initially discussed what was arguably a more relatively balanced outlook for US economic growth. But since that time, two factors have gotten worse, in our view at least. First, of course, is the level of US trade tariffs, which in our view impose a negative drag on US and indeed global growth. Second is the worsening of the business and consumer confidence that we're seeing in some of the higher frequency data. So together, these make a strong case that economic growth is likely to slow in the coming quarters. Now, what's crucial here, of course, is slowing is one thing, but does growth stay positive or tip over into negative territory? That's actually quite important. In our base case, we continue to expect a soft landing, which is a world where US growth slows but avoids contraction, and we assign about a 50% probability to that. However, we do believe the risk of the US economy tipping over into a recession, which is 2 quarters of negative growth, have clearly gone up after the tariff announcement. We now assign about a 30% probability to that scenario. So in our view, what's really important in the coming days, weeks, and indeed months is to focus on trade negotiations between the US and ex-China partners. That really remains the key factor to watch, because that will determine where the average US tariff level ultimately settles, and hence what kind of magnitude that implies on the drag on economic growth.
So against this backdrop, as you've mentioned, our base case is soft landing and how the economic is likely to worsen in the coming quarters. What are our views of the equities today?
Well, I think that backdrop we just discussed leaves us with what I describe as an unusually high level of both policy uncertainty as well as market uncertainty. And in our view, what that means for equity markets is that the risk reward is somewhat less favorable than usual in terms of taking strong directional views in equities. That's why what we do this month is we're trimming our view on equities a little bit further, down to a core holding. Our strongest conviction at this time actually sit more on the portfolio head side. So that's gold, of course, and high quality bonds. Now, this view is actually quite consistent with some of the signals we're getting from our quantitative models. So the equity bond risk model argues that the downside risks for equities and bonds are much higher than usual, and that we remain in an environment that's favorable for gold. That, of course, feeds very well into our current views. Our stock bond model is a little more constructive, and actually on its own argues for a small overweight towards equities, but at the moment we're overriding that given our qualitative inputs. But within equities, of course, we continue to prefer a balanced exposure across major regions. So there's no change in that view over the past month. In the longer term, higher tariffs and what are arguably likely to be more resilient rather than efficient supply chains, in our view, pose some risk to the historically elevated US profit margins trend. Now, a soft landing scenario, which is still a base case, should support US equities as well via what we'd see as a stabilization of earnings expectations. US tariffs, of course, do raise some downside risk for other markets like Europe, but we do expect these to be at least partly mitigated by Germany's fiscal spending package and more recently, of course, the ECB's rate cuts. And finally, in Asia ex-Japan, we do retain a relative preference for Chinese equities within Asia. US tariffs are undoubtedly a headwind to growth. I think those are now well known, but we believe there are three factors that can help offset this, right? One is inexpensive valuations, which suggests more of that risk is priced. Second is, of course, the ongoing DeepSeek-led optimism. And third is indications that further policy support may be forthcoming on the fiscal side. But it's not just about Chinese equities in Asia, of course. We still retain a solid core holding on Indian equities, also because, the market's pre-Liberation Day weakness, suggests that, a lot of the downside risk was also priced here ahead of 2nd April.
I see. So I would suppose the preference for portfolio hedge points to higher quality bond in addition to gold, maybe?
That's absolutely right. So if you think about a focus area, so within bonds, we're neutral on bonds at an overall level, but within that we have an overweight towards developed market investment grade government bonds. So in our view, if we look at US bond yields, for example, we think it's attractive to add exposure as long as the 10-year US government bond yield holds above our 12-month expected range of about 4 to 4.25%. We did have a rebound in US bond yields, in the recent weeks. We think that was initially driven by fears of an unwind in arbitrage trades. But we do believe such worries are unwarranted in the long term because the Fed has the tools and indeed the experience from 2020 to address any unexpected spikes in yields. That's why we think the 10-year US bond yield can gradually move back towards 4% in our soft landing scenario, and indeed lower if we do end up in that recessionary scenario. So we think that it makes sense. The other portfolio hedge, of course, is gold. You can argue about the short-term positioning, which of course is quite extreme. But at the end of the day, longer term, we think gold remains attractive amid the uncertain environment that we described. And there are two big drivers here. One is continued strong central bank demand. And second is investor demand to also help mitigate inflationary or stagflationary risks that tariffs do introduce. So that's the other asset class where we maintain an overweight view.
Got it. So finally, one of the more notable moves was the weakness in the dollar. Is it set to extend?
Well, I'm glad you brought that up because looking beyond stocks and bonds, actually, we think one of the more significant moves in financial markets in recent weeks has been the break lower in the US dollar below its post-2022 range. So if you follow the dollar index, what we call the DXY, that's been in about 100 to 110 range that has persisted since 2022. But in recent days, of course, we have moved a little below that. And what's interesting is that break lower has happened independent of relative interest rate differentials, which argues that it's really the tariff policy shock that's been catalyzing dollar weakness. Now, in our view, we do believe this break lower in the US dollar has room to persist long term. So we're really looking at long-term risks of further US dollar weakness, albeit after a brief period of consolidation. So I think that feeds through a lot of our non-dollar currency views, including on some of the safe haven currencies which had gained in recent weeks, like the Japanese yen and the Swiss franc. So we expect the yen, for example, to move towards 140 and the Swiss franc towards 78 cents against the dollar over the next 12 months. I would point out, though, that a weaker dollar does support our view to, it's a positive for non-US equity markets. So it's supportive of our view to diversify exposure in equities beyond just US equities alone across the non-US world as well, in addition to the US.
Got it. Thank you so much, Manpreet, for the insightful sharing. So here are our top 3 takeaways. First, we still expect a soft landing for the US, but the risk for a hard landing has risen. Second, within equities, we continue to believe a balanced approach across different regions, both in developed markets and also emerging markets. Thirdly, the sharp drop in the dollar could be a start for a more prolonged decline. So for now, it is very important to stay diversified under this situation. So that's all we have for today. Just a side note that we've also published our global market outlook earlier today, so please refer to that for more details. Thanks for listening, and please stay tuned for the next one.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, Visit Market Views on the go on our website or click the link in the description.